Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 19 of Real Talk. I was out for a few weeks, one, because of my kids' spring break, but the other reason is the end of the first quarter was actually extremely busy. It reminded me of the end of a calendar year. This time it was because of the ULA tax that was imposed back in November, and its commencement date, effective date, is April 1st, or was April 1st. So a lot of transactions needed to close by March 31st. We were busy both on the buy side and sell side, mainly in the office sector. Vacant office, one was an office to resi conversion, and another was a large office transaction here in West LA, where the play is either a conversion to resi, conversion to medical, or just draft from the demand of Century City office, which is at an all-time low vacancy, really because of the migration of law firms and financial services firms leaving downtown because of the rise in homelessness and crime. With this ULA tax, I really got to give it to the city of LA, and I say that facetiously. I don't think there has been one law or ballot measure that has been passed that could do more detrimental effect to the city. The more private equity groups I talk to, the more lenders that I talk to are literally putting a red line through transactions, meaning they're done with the city of LA for now. It's just a significant hit. And as one person said, the city of LA is now your partner on the equity side for a substantial piece. This is not going to be good for the city, and I think their expectation of raising as much money to fight homelessness and help affordable housing is going to actually produce the opposite effect. It's going to exacerbate it because there's going to be less commerce, less economic activity in the city. Transactions are still getting done though. We're active throughout the country. We're doing multifamily deals from Vancouver, Washington, down to San Antonio, Tennessee, Florida, a new one just in St. Louis, surgery center in Austin, industrial development in LA, hotel development in Vegas. So things are getting done, just not at the pace that we were used to in 21 or 22. And simply put, we're probably not going to get there for a while. The expectation is after the summer vacation time, when we come back, third quarter, fourth quarter, things will pick up. People recognize that they do need to transact, and equity does need to be deployed. So we'll see. In this episode, I have a very fascinating conversation with Hamo Rostamian, the CEO and founder of NetVested. And we talk about the intersection of real estate and technology, transportation and energy. And Hamo is building and partnering with Tesla and other energy fuel efficient car companies in charging stations, Tesla charging stations, hydrogen fuel gas stations, and traditional fossil fuel stations, and the intermix between that service along with restaurants and retail and convenience stores. And he talks about where he's building strategically, where he's building and other what he calls necessities real estate. And you'll hear from him, besides those charging stations, what he believes is one of the most critically underserved retail components in our industry. I think you'll find our conversation with Hamo interesting, and hope you enjoy it.
Hello, and welcome to another edition of Real Talk. I am here with Hamo Rostamian, the CEO of NetVested Capital. Hamo, how are you today?
Fantastic. Great to be with you and the audience, whoever is listening out there. It's very exciting time to talk about what is going on with us and, with the world with respect to real estate in general.
Yeah, well, you say whoever's listening. Hopefully it's millions and millions of people by now.
Yeah.
But Hamo, for those that aren't familiar with NetVested Capital, why don't you give them a background as to your company?
Certainly, glad to do that. NetVested Capital was launched last year, actually, as a natural progression of certainly my career. I'm celebrating 40 years now in the business, and my partner Eileen Sarkisian has been with me for over 20 years, and some others who have joined us over the years. But really, my legacy and our background is in helping occupiers, particularly in the retail arena and food concepts, over the years, and helping them accelerate their store count and presence. So we're very, very proud of this legacy that has helped so many corporate entities as well as entrepreneurs who've succeeded. So we actually started years ago in the retail brokerage business and created a platform originally at Grubb & Ellis, who is not there anymore, but eventually with Richard Ellis up to 2006, and during which time we created a platform which really evolved into a full service spectrum of concepts, ideas, and assistance to conceptualize opportunities holistically for occupiers. And then obviously that became in most cases either a power center or some formation of shopping center. But it was a pretty exciting platform. And in 2002, we actually did something very magical, which was never done before. We became an extension of Target Corporation in Southern California at a time that Target really was really struggling to expand their footprint in their new formats. And we were very fortunate to meet and team up with the real estate director at the time. And between 2002 and 2008, we essentially created opportunities where Target opened 17 stores and with about 8 million square feet of ancillary other tenants around these stores.
Now, sorry to intervene, but did you do that as a broker or as an owner of those Target stores?
No, we never owned any real estate. It was actually an agreement that we had not to participate. But we did provide pretty much anything from calibration of consumer behavior and psychographics that really were then eventually confirmed by Target. And, finally they made a decision, of course, on those locations. But I think more critically was really functioning as a full service developer team pretty much, and then taking those projects to Target and eventually to a developer who we obviously have a lot of good friends in the business who then executed on the project from a physical point of view. But I mentioned that because our business has evolved into a lot more than transaction, I think. And then in 2006, we started Strategic Development Advisors, which is still our legacy company, continuing to do very much the same. And then I think it was 2010, we started HRI Development as a second entity that kind of was harmonizing with SDA. So we've then, since then, we've executed on multiples of single tenant projects in the retail and food category. And last year, we kind of completed the platform by adding the capital markets component, whereby we are raising funds and equity and capital to execute on projects. So it is extremely unusual, I think, to find a platform where you have everything from concept calibration of opportunities and real estate itself, all the way to executing on projects, completing and occupying them, which really gives us a very unique, I believe, presence now in the capital markets arena, where our funds are able to actually very quickly place money and not really wait for opportunities to be presented, because we have a continuity of pipeline projects that really are in need of execution.
So are the projects that you're developing now, which you are in the ownership of and raising funds to develop, or I should say, are your projects mostly or exclusively ground up development, triple net retail deals?
Yes, that is our philosophy in populating the pipeline, as well as where the funds are invested. So we have coined a term which is a bit comical, but it's known as necessitale, and it's kind of combination of retail and necessity, because I think in most conversations, retail becomes very generic. So as an asset category, I think it becomes very convoluted, because you have such variety of risk and reward in those asset types. But we've always focused on what is necessity. And so that would be your grocer, your pharmacy, your childcare, all of your fast food drive-through concepts that are proven. And obviously, the fitness category, which a lot of people have reservations about, but we do consider that as a necessity.
Sure. Well, necessity retail. I mean, I had a podcast with Jim Dillevu of Paragon a couple months ago, and in talking about necessity retail today with capital, it has become one of the most favored asset classes in real estate. Everyone, multifamily, is having certain issues. Office, obviously, significant issues with office. And, the view for many years is that retail had so many headwinds from, online shopping to the expense of tenanting and paying tenant improvements. And now there's a shift, at least with respect to necessity retail, where a lot of equity feel that they are under allocated to that asset class.
That's correct. I think in a very unfortunate way, I think COVID proved that, where you saw, many communities that have been up in arms about drive-throughs. I mean, they realized, in the political arena and in sort of activism arena, particularly in California, I think most people realize that if it was not for the drive-through concepts, that many of these necessity items, would be very difficult to access. So I think there is certainly just a very solid recognition now to that category. One of the things that we've always said, in our sort of in our circles, is that while the internet commerce certainly has a very strong position, and that is on its own necessity, but in the evolution of the marriage between brick and mortar and the internet commerce, it is inevitable that many of the internet concepts would eventually have to occupy brick and mortar. And I think that's been proven now with certainly Amazon, making headway in occupying space in other stores, and eventually having acquired, for example, Whole Foods in our market, and now really making a big push with the Amazon Fresh. So I think it's all going to be evolving into a sort of a balance, and within that balance, we really feel very strongly that I think a very substantial arena for success lies with necessity-based retail.
So let's drill down a bit, because still necessity-based retail can still be broad. So what are the types of tenants or specific tenants that you own in your portfolio that of the real estate, and locations?
So we've always been very focused on again, a balance between drive-through concepts. We've been engaged with Starbucks and multiple opportunities. For example, we've been very successful with them. Grocery outlet, for example, is obviously a regional name that is really growing in popularity. And I think a lot of people that have not been into a grocery outlet, for example, in our market, when they go in and they see, the philosophy behind the merchandising, which is really a value-oriented shopping experience, but it is driven by a very strong acquisition of product category strategy, where they have more limited sort of varieties of the same products, but they offer very good price and very high quality. So we favor these concepts. For example, a grocery outlet, where we do see that they're gaining strength in a very particular segment of the retailing. But I wanted to also not forget to mention that our substantial amount of our focus right now is on what we call the fueling stations of the future. And I think that's a subject I wanted to share with you very passionately, because with what is going on with the evolution of powering vehicles, I think that is certainly, from our perspective, going to be a very strong category. So we see that as a necessity as well.
Sure. So these fueling stations, are you owning the real estate and leasing them to operators of the fueling stations, or are you part of the ownership of the fueling station, of the operations itself, the cash flow from the business of fueling stations?
So we magically sort of teamed up with Tesla in our market, again, out of necessity, in a different sort of, I guess, definition. But we very quickly realized that the EV sort of charging arena is really going to be crystallized into formats. In the past 7 to 10 years, I think EV charging has become more and more, needed, and really moving into the necessity category for various reasons, which we can touch on. But the evidence is that many of the larger companies, particularly the oil companies, and I don't know if you've heard, but just a few days ago, Shell Oil purchased Volta, which was one of the brand names that was had a substantial position. So I think the oil companies, for example, realize that what we are talking about, which is these fueling stations of the future, really has to be comprehensive, and not that you really want to necessarily give up on fossil fuel. And I think they're, again, like internet commerce, it doesn't have to be one or the other. I think that's kind of balance out to include everything. So, for example, we have a project that we're going to start construction shortly along the Interstate 5 in the Fraser Park community, going basically from away from LA towards Bakersfield. That's a pretty large mountain community, and it's a travel center. Mm-hmm. So there, we are doing a traditional gas station format with a very large food and a convenience component. And I cannot mention the operator or the brand name, but it's a.
But is this a lease? This is a lease where you will own the real estate and lease it.
That's correct. So basically the fund is investing in these properties with very substantial credit, occupiers, long-term leases. And so we're essentially utilizing our platform to identify, secure, execute on these projects and with the investors that we have and essentially enjoy benefits. But in this case, imagine a 4-acre site where you have, a traditional, state-of-the-art, essentially fossil fuel, basically called gas station, with a major, very large building that provides, all the C-store components plus, very luxurious restrooms and so forth. And then with that, we're actually opening a 120 stall charging station for Tesla. So it is a very new sort of arena, but and it's not necessarily an easy product to put together.
Sure.
We feel very strongly that this will become a new model for these, what we call the fueling stations of the future, because it's just going to happen, very quickly.
When you identify locations for this particular project, whether this specifically or others in the future and in general, do you close on the project? When you close on the project, do you already have these key tenants, whether it's Tesla or the fossil fuel tenant or the restaurant convenience store tenant, already signed up? Or are you speccing it where you're buying, closing on the land, and then hoping to get the tenants?
So we've never done a speculative project.
Mm-hmm.
It is always that we have our leases in place. It is possible that sometimes we don't have maybe our building permits necessarily on hand, but entitlements and leases are always an absolute must. So we don't close on properties until we have those two.
Sure.
And because these are easily and usually a single tenant or maybe two tenants, I mean, these are not going to be multi-tenant, very large multi-tenant shopping centers. We are categorizing these as single tenant leased assets. So all of these, we have 5 of these right now that are in execution. And I think we have like 17 that are in different, consideration stages of consideration.
So you're capitalizing the deal by buying the land, but how much of the improvements from the fueling station to the retail component are you providing capital towards?
I'd say majority of these concepts are going to be where we pretty much deliver the infrastructure and the finishes. In the case of Tesla or any other EV partner we may have or tenant we may have, typically they bring in their infrastructure. We obviously assist with the process and make sure the product and the guest experience is perfect. And in the case of dealing with, let's say, a gas station occupier, typically our arrangements are reverse built to suit. So we do not want to interfere with the technology or the technical aspects of building a fueling station. I think that's something that could be done much better by the operators. So essentially, we finance it in a reverse mode. So we provide, the capital or the dollars, but they do it, and then we basically own it.
And what's the time from the time you close and you have full entitlements to build to it being ready for business, more on the fuel EV side? How long does it take to build those out?
It's actually very quick. Once we have the entitlements, and one of the benefits I think we have in the space today in this particular moment in time is that I think we have very strong political and activist winds that are beneath our wings, because you typically are fighting something as a developer. But in this case, I think the political winds are completely in our favor, because again, we're just responding to all the excitement about clean energy, and we're responding to the popularity of this type of energy. So it would be probably about a year typically it would take. So it's compared to a shopping center ground up, I'd say certainly a lot faster.
And so what's in terms of the capital, you've raised a fund, or in the process of raising a fund for these types of investments and your other net investments, and that's on the equity side. What type of debt financing is there for the construction of these types of fuel sites?
So we have a very strong, reputation with the type of construction lenders that this requires, and these are typically the bridge construction lenders, and we sometimes are able to go all the way to 85-90% loan to cost, depending on the complexion of our investors that we have with us at that particular time. We sometimes do consider a lower loan to cost, but I would say that we have half a dozen relationships right now that are very excited about providing the construction loans for these projects, and so I think we're in a very good spot.
Mm-hmm. And what type of return on cost are you projecting, or you could be general if you want, for this type of asset class versus, building a Starbucks or building any other more traditional triple net necessity retail?
We typically want to be 150 to 200 basis points above our exit cap rates, which are a little bit difficult nowadays. We've sold some of our products, as recent as year and a half, 2 years ago, at like below 4% cap rate. And right now, I think we're more realistically probably, even for the class of assets we're talking about, the very highly desirable type of products with triple net leases and so forth. Even with that, I think you're going to be, somewhere in the 5.25, maybe 5.5. So, we keep track of that, and we try to be 150 or 200 basis points above that. And with leverage, obviously, that enhances the returns. So, we're very responsive to our investors, and what is the comfort zone. But because of the structure we have, and because of the type of product we're dealing with, we're able to maneuver, up and down the spectrum on the returns.
So in terms of location, and you mentioned this particular location on the way to Bakersfield. Are you focusing on more remote areas that are, in between metropolitan cities, whether it's, LA Bakersfield, LA Santa Barbara, LA Palm Springs, San Diego, where the land, I assume, would, has a pretty low cost comparative to building, in the central part of metropolitan cities?
Actually, the biggest percentage of our targeted sites are in infill areas.
Okay.
Some of them are extremely high grade as far as land. And really, we have to respond to the demographic, psychographic, and traffic patterns of this particular type of consumer or guest, we call So, for example, we have a project where it's an extremely desirable in a very, high grade location across from one of the major attractions in the greater LA area, and we're actually probably going to end up building a very high end market as a co-tenant. So where Tesla, for example, would be co-tenanting with a tenant like that. So it's really, we look for exactly where our occupiers want to be. Obviously, we want to make sure the real estate is first class for longevity, but I think that the travel centers, what we call that's the first one I described to you, really is more of a travel center, we call it. But I think majority of the projects are going to be very, very infill. And so it's, I think it's a time we find ourselves to be most creative I've ever been. And we really are excited about the opportunity to really bring out these potentials for these properties that otherwise would be maybe even looked at for multifamily or some other type of product.
I remember when you and I were sitting at dinner at the IMN conference in Laguna, in January. So it's now been a few months. You were telling me about hydrogen cars, right? And I'm not a car guy. I'm not a technology guy. I drive a fossil fuel car, so I'm a bit of a dinosaur. So I guess tell me first, how did you get into, this, what's driving your interest in technology, in automotive, in fuel efficient cars, and then what your opinion is on the technology of transportation. I mean, for years I've been going to conferences about how self-driving cars are going to be absolutely the wave of the future. And if you would have believed these people 5 years ago, 8 years ago, when I was at these conferences, it should have been here by now. And I feel like we're not even any closer. I don't know. So what's your opinion? I know it's a lot in that question, but just if you can give me your thoughts on that.
Certainly. My philosophy has always been that we have to be pragmatic and realistic, but be open to ideas, whether they're new or sometimes bring forward some older ideas, but really be open to creative ideas where it really improves the human experience in every way. So obviously, we depending on where we are physically, I think transportation is definitely a substantial component in human experience. So our attachment to our transportation modes is something to be always be considered, and it's an opportunity always to improve and refine. And I'm probably the kind of an interesting example of that because, I drive a hydrogen fuel vehicle, right, for my daily needs. At the same time, on the weekends, I hop in a Hummer. Sorry. So I have.
I'm sorry, I laughed. Oh, you drive what on the weekends? Humvee?
Humvee, yeah. So I have a Humvee. Yeah. It's a military.
So you have two extremes. You have the most efficient car out there, and
yeah. So I have that, and then if I want even go more fun, I drive the Porsche 4S. Which is a manual antique Porsche. But I think the point is that boxing ourselves in concepts or ideas as futuristic as it may be or as old as it may be is very limiting. So to that end, I think when we are in the investment arena, we need to be conscious of what is pragmatic and what is real. And that also has to include opportunity for creative ideas or new ideas. So I think, again, the fueling stations are a very good example because, I think we certainly have to be careful not to give up entirely on fossil fuel, because I think it will be there. Certainly would be less, maybe more refined. But I think for example, the hydrogen fuel cell concept, a third or fourth car in that arena. So I support that, and I think eventually we might have some challenges with creating electricity in the volumes that we're talking about. So having a self-sustaining concept like a fuel cell, where you don't have to rely on the grid, eventually will be taking hold. So it's just, I think, again, I think all of us have to kind of always think about how, when we're investing, where is that going with respect to the spectrum of human experience.
How much traction do you get from your fund investors when you are talking about investing in real estate projects where the end user are these, fuel efficient cars and other, modern technology uses, versus your more traditional brick and mortar uses like a Starbucks or a grocery store?
There is a lot of excitement. No, there's no doubt about it. I think the reason we find ourselves in a very unique position is that we are in the forefront and we have the platform to execute. I think many other friends of ours, are in the development arena. It would probably take them a good amount of time to figure out, what needs to be done or how to approach this. But there is, on the investor side, there's a lot of excitement. Certainly, there is some apprehension as well, because when you talk about the exit cap rates for products like this, it's just not plenty, of comparables out there. But principally speaking, if the returns are attractive, which they are, and that you are in the forefront, and that we're not really building a lot of buildings on these projects, I think it makes it very compelling. So we're excited and hopeful that very quickly we can actually have a very substantial portfolio.
Yeah, no, it's very exciting stuff, and to be on the cutting edge of both real estate and technology and transportation, definitely, forward thinking and mindful of the next many generations of how we're going to use real estate, especially as we're seeing, office in downtown LA become completely obsolete. Large shopping centers, inside shopping centers becoming obsolete. And so as real estate owners and stewards of capital, to be forward thinking as to, users of real estate over the next 20, 40, 60, 100 years, it's a credit to you, Hamo. Are you ready for the world-class or world-famous lightning round of Real Talk?
Yeah, absolutely. Yeah, anytime we're looking forward to it. Then
well, here, let me give you the lightning round questions. Okay, so quick answers to the next few questions, and then we'll wrap up. All right. What is your favorite, or what do you think is the best fuel cell hydrogen car out there?
I think the one that I have, which is the Hyundai Nexo, it's the only SUV actually that is available. So I think if someone is really looking for all four corners of the experience, I think that's a very good candidate. They actually stopped making that in 2022 for a 1-year pause, but I understand it's coming back in 2024 with an improved fuel stack. So that was, fuel stack was a problem they had. And again, with any new technology, it takes actual human experience, over and over with it to prove itself. So I'm hopeful that when they come back a year from now, that it would be a lot better.
What's one submarket or location that you have not transacted in that you would love to be able to find a deal and transact in?
Yeah, we are actually excited to basically go into the Arizona market. So I think the Houston area, and maybe Flagstaff. I mean, some of the areas that we really are seeing that some of the new concepts, would have a lot of receptivity, and it's needed. So we are looking for expanding outside California as soon as possible.
Besides transportation, which we've spoken about a lot, what segment within necessity retail do you feel is here to stay and nothing can penetrate it from COVID to the internet? What would you bet on in terms of a sub asset class within necessity retail?
So, we see one category I really want to emphasize is childcare. I think.
Oh, interesting.
Similar to electric charging, my partner Eileen, that I mentioned, she's very much into following and predicting and forecasting, human behavior, and we really are seeing that. Generally speaking, childcare is going to become actually a necessity well beyond what we have today. For example, we're building for a concept called the learning experience, and there's obviously others out there similar to them. But this concept is about 10,000 square feet. It's about 13,000 feet of playground, and they offer infant service. So imagine, as we again look at couples that are both working professionally, and they really want to have a kid, and so forth. So, and they may not have necessarily the generational support that, for example, we've experienced from parents and grandparents. Something like that, where you can actually, if you need to, be able to have a concept that takes care of your infant even, that becomes actually a very strong necessity category. So I think you're going to see childcare becoming an asset class from an institutional perspective very quickly. And I think there are opportunities there as well on the investment side.
Sure. Look, you're speaking to a father of two young kids, an 8-year-old and a 6-year-old, and my peers who have similar age kids. It's there's not enough child-focused real estate programming from infancy all the way through grade school, and then it evolves even to recreational activities, recreational sports. A client has represented a client in acquiring a completely vacant office building with subterranean retail. It used to be a gym right here in Century City adjacent, Beverly Hills adjacent, and things that we're talking about of utilizing that basement space really goes towards kids and youth sports and maybe childcare, and so talking about obsolete real estate and turning it into childcare or youth programming is one really creative way to transition real estate. And hearing you say it, it speaks volumes of, I think, an underserved but yet necessity retail.
Yes.
For sure. Well, Hamo, I really appreciate you coming on to Real Talk. It's, we've had a lot of guests on where we talk about, your traditional asset classes, but to spend, a few minutes talking about really exciting things in real estate and the combination of real estate and technology and transportation It's exciting stuff of what you're doing, and thank you for coming on, and best of luck to you and all of the projects that you have going on.
Well, thank you so much. And again, we're happy to come back anytime, and there is no limit to, I think, creativity in the human experience. So we're excited and look forward to, again, speaking with you and whoever else is interested. We're always available.
Great. Thank you, Hamo. Appreciate it.
Thank you very much.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.